Picture this. It is the early days of February 2026. The world has just witnessed a financial anomaly that was never supposed to happen. On your screen, the news anchors are having a meltdown about a silver crash. The charts are bleeding red, and the price is free falling down to $72 per ounce. You pick up the phone to call your dealer, thinking you're about to pull off the trade of the century. But the voice on the other end just laughs. They tell you there's absolutely no metal to sell at that price. If you want actual silver, the kind you can drop on your foot, the price is over $100. Meanwhile, halfway across the world in Shanghai, that exact same ounce is trading openly for $130. That is a spread of $58. It is enough to make an algorithm have a heart attack. This is not just a market glitch, it is a crime scene. And we are the only ones looking at the fingerprints. So, do yourself a favor, ignore the panic sellers for a moment and focus on the data, not the drama. Before we start the autopsy, let me know where you are tuning in from today. Are you watching from the vaults of Zurich, the markets of Mumbai, or the mining towns of Toronto? Let's strip this engine down and look at the mechanics of the crash. To understand why the price of silver collapsed on your screen while vanishing from the vaults, we have to look at the architecture of the paper market. What happened in late December of 2025 was not a sell-off by investors, it was a structural purge initiated by the exchange itself. We need to talk about the Chicago Mercantile Exchange, or CME. They are the casino owners. Their primary job is not to discover the true price of silver. Their job is to ensure the house never loses and the clearing members never default. In late December, they saw something that terrified them. The long positions, the people betting on the price going up, were accumulating too much leverage. If the price spiked quickly, the short sellers, which are primarily the bullion banks, would face catastrophic losses. They wouldn't be able to cover their positions, and the system would break. So, the exchange pulled the emergency brake. They raised the margin requirements. Let me explain exactly what that means. When you buy a futures contract for 5,000 ounces of silver, you don't pay the full price. You put down a deposit, a fraction of the value that is called margin. In December, the CME raised that requirement by 25% overnight. This is a brutal move. Imagine you are a trader holding a long position. Suddenly, you get a notification that you must deposit millions of dollars in cash immediately to keep your position open. You don't have the cash, so what do? You have no choice. You have to sell. You are forced to liquidate. When thousands of traders are forced to sell at the exact same time, the price crashes. It is a mathematical certainty. It triggers a cascade of stop-loss orders, driving the price down further, triggering more margin calls and more selling. It is a feedback loop of destruction. This is what the media called the bloodbath. They showed you the red candles and told you nobody wanted silver anymore, but they were lying, because while the paper contracts were burning, the physical metal was disappearing. This brings us to the second part of this mechanism, the decoupling. This is where the story gets strange. Usually, when the price of a commodity drops by 20%, the physical demand should cool off or supply should flood the market. But the opposite happened. As the spot price fell to $72, the premiums charged by dealers skyrocketed. If you tried to buy a silver eagle or a maple leaf in January, you realize that the spot price is a fiction. The dealers were not selling a spot. They were adding a premium of 30%, sometimes 40%. Why? Because the mints, the actual factories that turn industrial bars into retail coins, went on allocation. Allocation is a polite word for rationing. The United States Mint told its authorized purchasers that they couldn't order what they wanted. They could only take what they were given. This is a supply chain fracture. The price on the screen says silver is cheap and abundant. The supply chain says silver is scarce and critical. Now, let's widen the lens to the real predator in this water, the Shanghai Gold Exchange. While New York was busy crushing the paper speculators, the East was watching with a smile. This is what I call the pincer strategy. It is an unintentional but deadly cooperation between Western banks and Eastern sovereigns. When the CME smashes the price of paper, they inadvertently put a discount tag on the physical metal for any buyer who has the cash to take delivery. And who has the cash? China, India, the BRICS nations. They see the price drop in New York and they back up the trucks. They don't buy futures contracts. They buy the 1,000-ounce industrial bars directly from the vaults in London and Switzerland. This creates an arbitrage loop that is bleeding the West dry. They buy physical silver in the West. At the artificially suppressed price, they ship it east. And the moment that metal lands in Shanghai, It is revalued at the true market price, which is currently $58 higher than New York. Think about the incentives here. If you are a global bank, why would you sell silver in New York for $70 when you can ship it to Shanghai and sell it for $130? The only reason the price difference exists is because of the friction in logistics. You cannot teleport silver. It takes time to fly it, insure it, and refine it. And that is the bottleneck. The refineries in Switzerland are working 24 hours a day, 7 days a week. They are melting down the large Western bars and recasting them into 1 kilogram bars, which is the standard for the Chinese market. The flow of metal is entirely one way, from west to east, from the paper market to the physical market. This leads us to the most dangerous technical signal in the entire commodities market. It is a word that keeps bankers awake at night. Backwardation. Normally, a futures contract for delivery next month should cost more than the price of metal today. This is logical. You have to pay for storage, insurance, and interest. This condition is called contango. It is the sign of a healthy market with plenty of supply. But today, we are in backwardation. The price of silver for immediate delivery is higher than the price for delivery in the future. The market is effectively saying, I don't care about your promise to deliver silver in March. I don't trust that you will have it. I want the metal now, and I will pay a premium to get it in my hand today. Backwardation is the heartbeat of a shortage. It is the market screaming that the warehouses are empty. And if we look at the data from the CME vaults, specifically the registered category, the scream becomes deafening. You have to understand the difference between eligible and registered. The media will look at the total number and say there are hundreds of millions of ounces in the vaults. But that is the eligible category. That silver belongs to private investors, family offices, and banks. It is stored there, but it is not for sale at the current price. It is not available to settle a contract. The only silver that matters is registered. These are the bars that have a warrant attached, ready to be delivered to fulfill a futures contract. That number has plummeted to historic lows. It is dangerously close to zero. So here is the summary of the structure. The paper market is being suppressed by margin hikes to protect the banks from a short squeeze. This suppression is causing a physical shortage as the East drains the inventory. The premiums are exploding because the real market has decoupled from the fake market, and the technical signals, like backwardation, are confirming that we are running out of time. This is not a trading cycle. This is a liquidation of the Western financial system's ability to set the price of real assets. The mechanism is broken, and when it finally snaps, the gap between $70 and $130 will vanish in a single afternoon. To understand the endgame, we must look at the precedent. In the world of silver, all roads eventually lead back to 1980. If you read the headlines today, the financial journalists are lazy. They keep repeating the same tired comparison. They say we are witnessing another Hunt Brothers moment. They tell you that a few aggressive speculators are trying to corner the market, and that they will inevitably fail, just like Nelson and William Hunt failed 46 years ago. But this analysis is fatally flawed. It misses the single most important variable in the equation. The nature of the buyer has changed. Let's briefly re-examine the crime scene of 1980. The Hunt brothers were Texas oil tycoons. They were wealthy, yes, but they were individuals, and more importantly, they were greedy. They tried to corner the silver market using massive amounts of leverage. They bought futures, contracts on borrowed money. They were playing in the casino using the casino's credit. When the price of silver hit $50 an ounce in January of 1980, the establishment panicked. The Federal Reserve and the exchange regulators realized that the Hunts were about to break the banking system. So, they changed the rules in the middle of the game. This is a critical lesson for what is happening today. The exchange announced Silver Thursday. They implemented a rule called liquidation only. Suddenly, nobody was allowed to buy. You could only sell. They cut off the buying pressure instantly. Then, they raised the margin requirements, just like we saw in December 2025. The Hunts were trapped. They couldn't meet the margin calls. They were forced to sell into a falling market. They went bankrupt, and the price of silver crashed from $50 down to $10. The establishment won. The paper market crushed the physical buyers because the buyers were levered. Now, fast forward to February 2026. Look at the buyer on the other side of this trade. It is not two brothers from Texas. It is the People's Bank of China. It is the Reserve Bank of India. It is the Russian Federation. It is the sovereign wealth funds of the Middle East. These are not speculators. They do not buy silver on margin. They do not use leverage. They pay cash, they take delivery, and most importantly, they do not care about the dollar price. This is the critical difference that the Western banks failed to calculate. You cannot issue a margin call on a sovereign nation that holds the physical metal in its own military-guarded vaults. When the CME raised margins in December, they were using a weapon designed to kill speculators like the Hunt brothers. And it worked on the hedge funds. It worked on the retail traders. But it did absolutely nothing to stop the strategic accumulation by the East. In fact, it backfired. By crashing the paper price, the West effectively subsidized the East's accumulation. It is the greatest strategic blunder in modern financial history. This brings us to the geopolitical axis of this crisis. We are witnessing the weaponization of the Shanghai Gold Exchange. For decades, the price of silver was discovered in New York and London. It was determined by trading fractions of a penny on high-frequency algorithms. It was a derivative game. The physical metal was just an afterthought, but the balance of power has shifted. The Shanghai Gold Exchange operates on a completely different operating system. In Shanghai, the rule is simple. If you sell silver, you must have the metal. If you buy silver, you must take the metal. It is a physical-first market. China has been preparing for this moment for 20 years. They have been quietly importing thousands of tons of gold and silver. They have encouraged their citizens to buy physical bars. They have halted the export of silver mining production. China is the largest producer of silver in the world, yet not a single ounce leaves the country. It all stays within the borders. On top of that, they are vacuuming up the supply from Mexico and Peru. Why are they doing this? Because they understand the industrial reality we discussed. They know that silver is the strategic oil of the 21st century. You cannot build a modern military, a solar grid, or an electric vehicle fleet without it. The game rules of the silver market are undergoing a fundamental north-south pole reversal. In this landscape of global physical migration, what we most easily overlook is this. If the original pricing power completely fails, what exactly should our assets be anchored to help us navigate this? We have internally organized a copy of the Silver Wealth Explosion Guide to help identify which assets are truly holdable in this decoupling between paper promises and physical reality. I have placed this manual in the comments section. Click to claim it. The West treats silver like a financial asset, a line on a chart to be traded. The East treats silver like a strategic material, a distinct element in the periodic table that is essential for national security. This creates a geopolitical arbitrage. The West sells silver to suppress inflation expectations and defend the fiat currency system. The East buys silver to build the infrastructure of the future. We must also look at the year 2011. That was the last time silver threatened a breakout. It hit $50 again, and again, the CME raised margins 5 times in 9 days. They smashed the price down. It worked then because the market was still dominated by Western investment funds. But today, the flows are different. The disconnect we see between the London spot price and the Shanghai price is the evidence of a broken system. The West is running out of ammo. The ammo in this case is the physical bars in the London vaults. Every time they smash the price down with paper contracts, they accelerate the drainage of the vaults. It is a paradox. To save the price-fixing mechanism, they have to destroy the inventory. The geopolitical implications are terrifying for the dollar system. If the Shanghai price becomes the reference price for the world, then the CME becomes irrelevant. If miners in Mexico and Peru decide to sell their product to Shanghai for $130 instead of selling to New York for $72, the COMEX defaults. It ceases to function as a delivery vehicle. This is the definition of a force majeure event. The Western financial system relies on trust that the contract will be honored. Trust that the price on the screen is the real price. That trust is evaporating. We are seeing a return to Gresham's law, but with a geopolitical twist. Bad money, the paper derivatives, drives out good money, the physical metal. The physical metal is fleeing the jurisdiction of the dollar and moving to the jurisdiction of the yuan and the rupee. The ghost of the Hunt brothers is watching, but this time the outcome will be different. The Hunt brothers were trying to make a profit in dollars. The sovereign buyers of today are trying to exit the dollar entirely. They are not trying to corner the market to sell it back to you at a higher price. They are cornering the market to keep it. They are taking the ball and going home. And when the vaults in London are finally declared empty, when the registered inventory hits zero, the geopolitical leverage will shift instantly. The West will have to come to the East, hand in hand, asking to buy back the metal they sold so cheaply, and the price then will not be $130. It will be whatever the owner says it is. This is the history being written right now. It is not a cycle. It is a secular shift. The era of paper manipulation is ending and the era of physical consequence is beginning. While the bankers play their games with paper contracts and the politicians maneuver for geopolitical leverage, there is a third force at work that is even more relentless. It is the force of physical necessity. We need to talk about the industrial reality of silver, because this is where the math becomes terrifying. For thousands of years, silver was money, but in the 21st century, it has become something far more critical. It is the electrical blood of the modern world. You cannot have a green energy revolution without it. You cannot have an artificial intelligence boom without it. You cannot have a modern missile guidance system without it. And right now, in February 2026, the industrial sector is starving. Let's look at the solar vampire. This is the nickname insiders have given to the photovoltaic industry. 5 years ago, analysts predicted that solar panels would become more efficient and use less silver. They were wrong. The industry shifted to new technologies like TOPCon and HJT cells, which actually required more silver per unit, not less. The data from the Silver Institute is unequivocal. In 2025 alone, the solar industry consumed nearly 25% of the entire global mining supply. That is a staggering number. One single industry is eating a quarter of the pie, and unlike gold, which is hoarded in vaults, the silver in a solar panel is consumed. It is locked away on a rooftop for 30 years. It is gone. It does not come back to the market. This industrial demand is price inelastic. If you are a manufacturer like Tesla or Samsung and the price of silver goes from $70 to $100, you do not stop buying. You cannot stop. Silver is a tiny fraction of the total cost of your product, but without it, the product doesn't work. You pay the price. You pay whatever the market demands. This unyielding hunger from the industrial sector has collided head-on with a broken supply chain. And this brings us back to the anomaly of the premiums. Why is there such a massive gap between the spot price and the price you pay for a coin? The answer lies in the refineries. This is a logistical bottleneck that very few people understand. Right now, the major refineries in Switzerland and North America are operating at maximum capacity, but they are not making coins for retail investors in the West. They are fully booked fulfilling orders for the East. They are working 24 hours a day to convert Western good delivery bars into Chinese standard 1 kilogram bars. The retail investor is being squeezed out. This is why the United States Mint is on allocation. When a mint goes on allocation, it is a polite way of saying they have defaulted on their mandate to supply the public. They are rationing sales. Dealers are calling the mints begging for product, and the mints are hanging up the phone. This is the definition of a broken market. In a functioning free market, if demand is high, supply rises to meet it. But here, the price signal is jammed. The paper price is too low to incentivize new mining production, but the physical demand is too high for the existing inventory to satisfy. And nowhere is this danger more visible than in the fine print of the largest silver ETF in the world, SLV. Most investors treat SLV like a bank account. They think they own silver. They do not. If you take the time to read the latest upgrades to their prospectus, you will find a warning that should send a chill down your spine. The lawyers inserted a clause admitting that in times of extreme market volatility or supply shortages, the fund may not be able to acquire enough physical silver to back the shares. Think about what that means. The fund that is supposed to track the price of silver is telling you, in legal black and white, that they might just become a paper tracking vehicle with no metal behind it. If the SLV runs out of metal, they will not give you silver bars. They will sell your position in cash. They will give you a check for the suppressed paper price of $70 while the real metal trades on the street for $200. You will be cast out of the trade of a lifetime right at the moment it pays off. This is the force majeure scenario. It is the moment when the paper promises are broken. We are seeing the shelves go empty. Go to your local bullion dealer's website right now. Look at the inventory. You will see the words out of stock or pre-order everywhere. You are being asked to pay today for metal that might be delivered in 3 months. That is not a purchase. That is an unsecured loan you are giving to the dealer. The supply chain has snapped. The miners are struggling with rising energy costs and falling ore grades. The refineries are bottlenecked. The vaults are being drained by sovereign buyers. And the paper market is pretending that none of this is happening. We are standing on the edge of a cliff. The industrial users are starting to panic. We are hearing reports of major electronics manufacturers bypassing the COMEX entirely and trying to sign direct offtake agreements with the miners. They want to secure their supply at the source before the music stops. When Apple and Samsung decide They need to hoard silver to keep their factories running. The game is over. The price will not just rise. It will reset. It will disconnect completely from the paper charts and find its true equilibrium based on physical scarcity. The data is screaming at us. The warehouses are emptying. The premiums are exploding. The mints are rationing. The industry is desperate. This is not a drill. The supply chain has already failed. The public just hasn't realized it yet because they are still looking at the wrong price tag. We have arrived at the final verdict. We have dissected the anatomy of the crash, exposed the pincer attack between Chicago and Shanghai, and witnessed the breaking of the industrial supply chain. Now, we must face the uncomfortable question: what happens next? We are moving towards a singular event horizon that insiders call the force majeure. In contract law, force majeure is a clause that frees both parties from liability or obligation when an extraordinary event or circumstance beyond their control prevents one or both parties from fulfilling their obligations. In the context of the CME and the London Bullion Market Association, it means one thing: they stop delivering metal and start printing checks. This is the ultimate rug pull. The system is designed to protect the banks, not the customer. When the inventory in the registered category finally hits zero, or when the backwardation becomes so severe that the exchange cannot function, they will not declare bankruptcy. They will simply declare that the contract can no longer be settled in physical silver. Instead, they will invoke the cash settlement rule. Let me paint you the scenarios to illustrate exactly what this means for your financial survival. Scenario A: the paper trap. You are a prudent investor. You saw the data. You knew silver was undervalued, so you bought $50,000 worth of an exchange-traded fund or a futures contract. You feel smart. You are long silver. Then, the reset happens. The Shanghai price rips to $200 an ounce as the shortage goes public. You check your brokerage account expecting to see a massive profit, but you do not. Instead, you receive a notification your position has been closed out by the exchange at the last official settlement price. That price is the manipulated paper price of $72. They deposit $50, zero back into your account. You are furious. You take that cash and run to a dealer to buy real silver, but the dealer tells you the price is now $150. Your money, which you thought was protected, has lost 70% of its purchasing power overnight. You were right about the market direction, but you were wrong about the vehicle. You were holding a claim check for a code that had already been stolen from the cloakroom. Scenario B: the physical exit. You understood that in a crisis of trust, possession is 9/10 of the law. You ignored the convenience of the ETF. You paid the high premiums. You bought the monster boxes of silver eagles. You took the heavy bars home. You became your own central bank. When the force majeure is declared, it does not affect you. In fact, it empowers you. The paper market dies, and the physical market discovers its true price. The spread collapses. The price of silver in New York instantly reprices to match Shanghai. The wealth transfer is complete. You are not just preserving capital. You are holding the only asset that the industrial world desperately needs but cannot print. This is not speculation. This is a defensive strategy against a systemic default. The world is drowning in $300 trillion of global debt. That debt can never be paid back in real value. It can only be defaulted on or inflated away. The central banks have chosen inflation. The bloodbath we saw in February is just the desperate thrashing of a dying fiat currency system, trying to maintain control over real assets. We are entering a period where the return of your money is far more important than the return on your money. Do not wait for the Wall Street Journal to announce the shortage. By the time it is on the front page, the dealer shelves will be bare. The premiums will be 100%. The window of opportunity is closing. The divergence between the paper price and the physical price is the final warning siren. I cannot give you financial advice. I can only give you the map of the minefield. The map says the paper path leads to a trap, and the physical path leads to freedom. The choice is yours. Do not trust the words of the central bankers. Trust the weight of the metal in your hand. The silver track has transformed from a simple logic of ups and downs into a high-stakes trial for asset certainty. The current market situation is driven by global physical flows, shifting underlying rules at the exchanges, and industrial consumption figures that are rarely made public to provide everyone with a clearer reference anchor when facing these extremely complex variables. We have internally organized a copy of the Silver Wealth Explosion Guide. I have placed this manual in the comments section. Click to claim it.